Does more debt truly spur economic growth, or does it just set the stage for financial disaster? This is the debt-growth conundrum, a puzzle that economists and policymakers have been trying to solve for many years. To really understand this, we need to first grasp what we mean by debt. Debt is, in essence, borrowed money. It's a promise to pay back the sum borrowed, usually with an added interest. Debt can be incurred by individuals, corporations, and governments. For now, let's focus on two main types: government debt and household debt. Government debt, also known as public debt, is the amount of money that a government borrows, typically through issuing bonds. Governments often run into debt to finance projects, provide public services, or stimulate economic growth. This is based on the idea that the investment today will pay off in the future through increased productivity and economic output. On the other hand, household debt is the amount owed by all individuals in a country. This can be in the form of mortgages, student loans, credit card debt, and so on. The level of household debt can be a significant economic indicator, showing the willingness of consumers to spend and thus stimulating economic activity. However, as with most things in economics, it's not that straightforward. While debt can fuel economic growth, it's a double-edged sword. Too much debt can lead to financial instability and economic crises. So the key question here is not whether debt can stimulate growth, but how much debt is just right. This brings us back to our original question. Does more debt truly lead to economic growth, or does it just set the stage for financial disaster? There's no easy answer to this. It depends on a host of factors, including the nature of the debt, the state of the economy, and the policies in place to manage the debt. So let's dive into the heart of the matter, the arguments for and against the idea that more debt boosts economic growth. Some economists argue that debt, particularly government debt, can fuel economic growth. This statement might raise a few eyebrows, especially considering the negative connotation often associated with the word debt. However, let's delve into the logic behind this argument. The rationale is that when governments borrow money, they're essentially injecting funds into the economy. This borrowed money can be used to finance public works projects, like building infrastructure or investing in education and healthcare. These investments not only create jobs in the short term, but can also boost productivity in the long run. For instance, a better educated workforce is likely to be more productive, and good infrastructure can make businesses more efficient. This argument gains support from Keynesian economics, named after the British economist John Maynard Keynes. He believed that government spending could help pull an economy out of a recession by stimulating demand. When the private sector is unwilling or unable to spend, Keynes argued, the government can step in to fill the gap. Now, let's consider some historical examples. In the United States, following the Great Depression of the 1930s, the government embarked on a massive public works program known as the New Deal. It was funded largely through borrowing, and many economists credit it with helping to revive the American economy. More recently, during the financial crisis of 2008, many governments around the world increased their borrowing to fund stimulus packages. Some economic studies suggest that countries which borrowed and spent more during the crisis recovered faster than those that did not. However, it's important to note that not all studies agree with this conclusion. The relationship between debt and growth can be complex and influenced by many factors, including how the borrowed money is spent, the health of the economy, and the level of interest rates. In addition, there's a concern about the sustainability of debt. While borrowing can provide a short-term boost, it also leads to future obligations. The borrowed money must be paid back, often with interest. This means that future revenues will be used to service debt rather than being invested in the economy. Therefore, while debt can be used as a tool to stimulate economic activity, it must be managed carefully. The key lies in ensuring that the borrowed money is spent in ways that will stimulate economic growth and generate sufficient returns to pay back the debt. So the argument for debt isn't about advocating for reckless borrowing, but rather about understanding the role that debt can play in managing an economy. It's about recognizing that under certain conditions, borrowing can be a tool for stimulating economic activity and promoting growth. This perspective suggests that debt, managed properly, can be a tool for economic development. But is it that simple? On the flip side, there are those who see debt as a hindrance to economic growth. Let's start by exploring the argument that high levels of debt can lead to financial instability and economic crises. It's important to remember that debt, by its very nature, is a promise to pay in the future for what we consume or invest in today. But what happens when the future arrives and the bill comes due? Many economists argue that excessive debt can create vulnerabilities in an economy, setting the stage for financial instability. A high debt load can make an economy more susceptible to shocks, such as sudden changes in interest rates or a downturn in the global economy. When an economy is heavily indebted, these shocks can trigger a cascade of defaults, leading to a financial crisis. Consider the global financial crisis of 2008. The crisis was triggered by a wave of defaults on subprime mortgages in the United States, which sent shockwaves through the global financial system. The subsequent economic downturn was the worst since the Great Depression. In the aftermath of the crisis, many economists pointed to high levels of household and corporate debt as key factors that amplified the impact of the shock. Research also suggests that high levels of public debt can be detrimental to economic growth. A seminal study by economists Carmen Reinhart and Kenneth Rogoff found that countries with public debt levels above 90% of GDP tend to have lower growth rates. Their research sparked a heated debate among economists, with some questioning the methodology and conclusions. However, the broader point that high debt levels can be a drag on growth remains widely accepted. But it's not just about the level of debt. The pace at which debt is accumulated can also be a risk factor. Rapid increases in debt, often driven by credit booms, can lead to asset bubbles and increase the likelihood of a financial crisis. This was the case in the lead-up to the Asian financial crisis in the late 90s, when a credit boom fueled by capital inflows led to a bubble in property and stock markets. So, is debt a ticking time bomb? Not necessarily. While high levels of debt can increase the risk of financial instability, it's not a guarantee of crisis. Much depends on the context, including the health of the financial system, the quality of economic governance, and the resilience of the economy to shocks. However, the cautionary tales from history and the findings from economic research suggest that we should be wary of the dangers of excessive debt. It's a delicate balancing act. Too little debt might stifle growth and investment, but too much debt can create vulnerabilities and dampen long-term growth prospects. This viewpoint paints a cautionary tale about the dangers of excessive debt, but what's the full picture? Beyond government debt, there's another piece to the puzzle: household debt. When we speak of debt, we often think of it on a national level. But the conversation doesn't stop there. Household debt, the sum of all money that all consumers owe, is an equally significant component of the overall economic picture. Now, you might think that because household debt represents money that people owe, high levels of it would be bad for the economy. But the reality isn't that black and white. In fact, the impact of household debt on economic growth can be a double-edged sword. On one hand, when households take on debt, they're able to spend more. This increased spending stimulates economic activity, which can boost growth. For example, if a family takes out a loan to buy a house, that's money going into the housing market, creating jobs and boosting the economy. But on the other hand, high levels of household debt can also pose significant risks. If households are heavily indebted, they may cut back on spending to pay off their debts, especially in times of economic uncertainty. This decrease in consumer spending can slow economic activity. What's more, research shows that high levels of household debt can make economies more vulnerable to shocks. A study by the Bank for International Settlements found that economies with high levels of household debt are more prone to experience deeper recessions and slower recoveries. So, while household debt can stimulate economic activity in the short term, it can also pose risks to long-term economic stability. It's a delicate balance. In conclusion, the relationship between household debt and economic growth is complex and multifaceted. It can stimulate growth by boosting consumer spending, but it can also dampen economic activity if it leads to a decrease in spending or makes an economy more susceptible to shocks. So, it seems that the impacts of debt on economic growth can vary greatly, depending on the context. It's clear that the relationship between debt and economic growth is complex. Let's take a moment to recap the arguments we've explored thus far. On one hand, we've heard the case for debt. Proponents argue that debt, in various forms, can stimulate economic growth. They point to government borrowing as a tool for financing public projects, creating jobs, and improving infrastructure. They also highlight the role of corporate debt in fostering innovation and expansion, thereby driving economic progress. On the other hand, we've also considered the case against debt. Critics argue that excessive debt can lead to financial instability and economic downturns. They caution against the dangers of household debt, which can burden families, stifle consumer spending, and ultimately slow economic growth. These competing perspectives underscore the complexity of the debt-growth relationship. It's not a simple matter of more debt equals more growth or vice versa. The impact of debt on economic growth can vary based on a multitude of factors. These factors include the purpose of the debt, the terms of repayment, the overall economic climate, and the financial health of the debtor, among others. For instance, consider a scenario where a government borrows to invest in a major infrastructure project. If this project leads to job creation and improved productivity, it could indeed stimulate economic growth. However, if the same government borrows excessively without a clear plan for repayment or economic gain, the result could be financial instability and a potential economic downturn. Similarly, think about a household that takes on a mortgage to buy a home. This debt could be seen as an investment in the family's future, potentially leading to financial growth over time. But if that same household overextends itself with credit card debt, the result could be financial stress and reduced consumer spending, which could negatively impact the economy. So where does this leave us in our quest to answer the question, does more debt really lead to economic growth? As we've seen, the relationship between debt and economic growth is far from straightforward. The question, does more debt really boost economic growth, is one that cannot be answered with a simple yes or no. It's a complex issue that requires a nuanced understanding. Let's take a moment to revisit the key points we've discussed. We've looked at the case for debt and how, when used strategically, it can stimulate economic growth. Governments can borrow to invest in infrastructure, education, healthcare, and other public services, which can, in turn, drive productivity and economic activity. In the short term, this can lead to an uptick in economic growth. On the flip side, we've also examined the case against debt. We've seen how excessive debt can lead to economic instability, harming long-term growth. When debt levels become too high, servicing that debt can become a burden, diverting resources away from productive investments. In some cases, it can lead to a vicious cycle of borrowing and spending, potentially leading to economic crises. We've also explored the impact of household debt and how it can play a role in economic growth. While it can boost consumption in the short term, excessive household debt can lead to financial instability, negatively affecting long-term economic growth. The relationship between debt and growth is therefore a delicate balance. It's not about whether debt is good or bad, but rather about how it's managed. Debt can be a powerful tool for stimulating economic growth, but it needs to be used responsibly. This brings us to the importance of context. The impact of debt on economic growth can vary greatly depending on a multitude of factors, such as the state of the economy, interest rates, and the nature of the expenditure. For instance, debt incurred to finance productive investments that yield a high return can be beneficial for growth. Conversely, debt incurred for unproductive purposes or in an environment of high interest rates can be detrimental. So, what is our overall conclusion? The evidence suggests that debt, in and of itself, is not inherently good or bad for economic growth. It can be either, depending on how it's used and managed. There's no one-size-fits-all answer. Ultimately, the answer to the question, does more debt really boost economic growth, is, it depends. It depends on the context, on how the debt is managed, and on what the borrowed funds are used for. The key is to strike a balance, ensuring that debt is used as a tool to support sustainable economic growth, rather than a crutch that could potentially lead to economic instability.